get into this. We're going to be talking about something I'm facing currently, a bias. Okay, well, let's just get into this. We'll start this from the very beginning, and yeah. Okay guys, so here we're gonna be talking about something I call comparison bias, yeah? And let's just get into it. Trader bias. I want this video to be quite short, unlike the last one, which was a 1 hour video. I want this to be very short. What this video will cover is identifying a common trader bias, which is comparing corrections to prior impulses. We'll get into that. And how this bias can make you miss perfectly valid structural trades. And we're also going to have examples from raw trades on GBP AUD with DOM refinements. Don't worry what DOM is, that is for me to know and for you not to know. And why this is specifically useful for viewers is this is going to help you trust structure over intuition. This is also going to show you how to extract more value from each market move. And this is also going to teach a mindset shift of if you can recognize a bias, then you're one step away from improving your edge. Because they say a problem identified is a problem half solved. That's very important on that. So let's first label what comparison bias is. Comparison bias is a trader's tendency to evaluate a market retracement by comparing it to the size or strength of the preceding impulse. Instead of judging a structural point on its own validity, the trader's mind overlays the previous move, leading to potential hesitation or invalidation of perfectly valid setups. So that's very, very important. I believe you guys got that. But that's a that's a big mouthful to understand that. So let's look at this diagram we have here. This is a continuation signature of a bullish trend, right? And I'm not sure if you guys can see my cursor here, but we have our higher high, our higher low, and our higher high, breaker structure, continuation signature. We form our higher low, and then we break structure forming our higher high. Breaker structure, continuation signature. Here's the thing. You see this blue box from the higher low all the way to here. That's a very huge move. We have not had any retracements or pullbacks. This is called pullback only. We have not had a pullback. And then we get this small pullback. Do we regard this as a structure point? Or is this still part of the same run or the same impulse? Are we still forming our higher high, or when this blue box ends at this high, is that our higher high where we get a small move toward the downside? Is that small move toward the downside our higher low? How I normally do this is I neglect it, definitely. That small move, this in the purple box, if you zoom in a little bit more, or you look toward the side, or you look toward the side, you can see that there's a purple box there. My eyes are a little bit deceiving me, but I know there's a box there. I know this. I would not really count that as a pullback at all. I would wait for a much deeper pullback. That is what a comparison bias is. It is comparing this small move, this small pullback, to this huge move. And I'm saying that because we have such a huge impulse, then the correction must also be very, very huge. It must not be small. And because of that, I miss trades. Let's go. You got, yeah, let's go. Key aspects of comparison bias is it occurs when comparing a retracement to the preceding impulse, and this can cause traders to skip trades that the system would normally validate. And we also need to realize that the system itself does not require retracement size proportionality. It only evaluates structure and order flow. This is very important. What that line says essentially is this. It says that the system does not care if the size of the impulse or retracement is the same. It only evaluates structure. So if we have a higher high and a higher low and a higher high, that is a structure point. Those are structure points. Now the system is looking to buy within that trading range. We identify order flow and all of these things. Yeah, we enter utilizing depth of mitigation. Right. So a scenario of comparison bias is when we have a strong bearish impulse and a small upward pullback. I think that, well, this is too small. We need a uh, deeper pullback essentially, or deeper retracement, so that I can say this is a valid lower high. But then what I'll do with that small upward pullback is I'll invalidate that structure, and the result is price pushes even lower. Price pushes even lower, and then we form a lower low, get a break of structure, continuation signature. Price comes back, get that tap in, push even lower, guys, and the system would have given a 1 2 3 R. Psychologically, this would lead us to regret things, overthink it, and lead to emotional stress. The key takeaway here is that the system is fine, but the bias can cause missed opportunities. So yeah, this is comparison bias in effect. Here we have a chart of pound against the Australian dollar, or pound against Aussie. So this is our swing high, this is our swing low, and everything in here is internal price action. So this is the lowest point in the swing low and the swing high. This is our high low, and we start to get that push upward, going to take out that high. We take out this high, we get that small correction. The question here is this: is this regarded as a structure point, or do we neglect it and say we need a deeper pullback because this entire move is too huge for this retracement to be valid? This is comparison bias, mate, and we're gonna miss trades, yeah, because of this. Let me show you this. This is chart breakdown number 1. We get that small correction that we invalidate and say it's not a structure point. And guess what happens? We get that small correction, and let's just say this is our higher low. We get that push out, we get our higher high, break of structure, continuation signature. What happens? We identify our order flow. It is associated with inefficiency, and we utilize DOM refinements, and this was a 1 to 4R trade. As you guys can see, it would have been a trade that hit TP. So this trade would have been missed if comparison bias had invalidated it. Yeah. And the key thing here and the key takeaway here is this: we need to trust structure plus depth of mitigation over subjective comparison of retracement versus impulse, and that recognizing this bias can in the future prevent missed IRR trades. And this is the follow through after the first trade. As you guys can see, I don't really need to break it down for you. All you need to know is we utilized DOM for our entry, and we got a 1 to 3R, and the outcome is that the trade won, as you guys can see. And yeah, the context of this is we would have missed this trade as well if we had neglected that as our real structure point. So I need you guys to really, okay, this is for me, this is literally for me, yeah. And the thing is this, yeah, this is a problem I'm dealing with, and I just wanted to come into your space to share with you guys. Sorry about that thing that was there beside me. I wanted to come into your space and share it with you. And you can basically copy the strategy from all of these chart breakdowns, from all of the things I'm going to be sharing with you, the backtesting results, all of these things. I'll give you guys a little teaser at the end of the video. You'll see something crazy, how the system actually works and how it performs. But yeah, the key takeaway is that comparison bias can make you skip profitable trades. And it did make us skip 2 profitable trades that would have netted us 6% because it's a fixed 1 to 3 R system. We would have missed 6%, which is weekly EP. If you watched the previous video, the 1 hour long video, you would have seen how I want my ideal system to perform over the course of the week. We would have made 6%. Yeah, we would have made 6%, and that's EP, mate. We are above EP, within the range that I want us to be in. So really, the consequences of comparison bias is missed trades, skipping perfectly valid structural setups. Let me be honest with you. The strategy I'm trading now is heavily what's the word I'm looking for? It is heavily reliant to market structure. So if I get structure incorrect, that's bad. That's very bad for me, man. Also, we get reduced system performance. For that week, let's say we never got any trade because we had comparison bias and we neglected that as a structural point. That we would have never made nothing. It's not a bad thing to not make nothing. You lost nothing, so that's better than making nothing is better than losing. That's just it. That's just it. But realizing that the system would have performed a 6% week, and we would have performance discrepancy where the system is making 6% in that week, but we made 0%. So that is something we want to really work our way at not getting affected by. And we also realize that expectancy dropped because high RR trades are avoided. So there is no high RR trades in my book. But every trade is the same. It's low RR, they're all medium RR, they're all high RR. It's the same shit. This leads to regret and frustration. Seeing the market hit TP later can cause self-doubt. You can be like, damn, if I regarded this as a real structural point, this would have been my order flow. Utilizing depth of mitigation, I would have gotten tagged in 1 2 3 or yes, we would have hit TP. This leads to overthinking and hesitation in future trades, which leads to a slowing decision-making process. I really don't think there will be hesitation. What there would be is FOMO, fear of missing out, where on the next trade we're gonna go in heavier. We're like, damn, that first trade worked, so the second one it has to work again. Because I didn't take the first trade, I'm going to go 2% here. And what if that trade loses? The second trade it won, but what if the second trade loses? You would have lost 2% when your system ideally is up 2%. So that performance discrepancy is really big. This is crazy, man. Trading is a very crazy business, yeah? And it leads to emotional stress. Frustration may lead to cautious or over aggressive behavior. Like I said, you go again big, or sometimes you get really scared. I really remember watching a podcast on Titans of Tomorrow. I recommend that channel, that trading podcast channel, to you guys on the previous video I made. I'm recommending again, go to YouTube and search Titans of Tomorrow. I don't really remember which episode it was, but there was a trader who was a pit floor trader, so yeah, institutional trader. And I remember he said he lost 200k in one trade, and he was afraid to trade for the next 3 months because he was scared. His hands would shake and all of these things. Guys, trading is dangerous. So frustration may lead you to be very cautious, and when you're cautious, you're passive aggressive, and what that does is you say, what if this trade loses? Because I lost that one, what if this one loses? And you don't take the trade and it wins. and you're like, okay, it won, but it could have lost. I'm not taking this trade, this new one, because it can lose because that one won, and this one might lose because probabilities. Looking at probabilities, one wins, your the trade. If the trade wins, you're one step closer to your next losing trade. And if that losing trade loses, you're one step closer to your next winning trade. Probabilities, what if this one loses because that one was a winner? And now you start reserving capital. Let me be honest. If you are like this is very, very, like I said, a system you can't trade psychologically. It's a system not good for you. This is very important. It's very important. And it also causes inconsistent trade locking. This is something I've actually, because I'm backtesting, it's very, very tedious to do this because you go back again. And another thing I've actually seen was a trade that was a winner, 123R, utilizing DOM refinements. It took 5 days to pay out. Utilizing, but when I go back again, I'm seeing how I could have gotten 2 more trades if I'd utilized internal structure within that range, and all of them were winners. By the way, I'll give you guys a teaser. Yeah, so skipped trades make backtesting and performance analysis messy. Trust me, it does. Ways to deal with comparison bias. I want to make this really fast. Ways to combat comparison bias is we need to trust the system. This is for me, like I said, this is for me, not for you guys. So I need to focus on structure and depth of mitigation, not the relative size of moves. It's very important. And we need to have predefined rules. Only validate trades by structural criteria. We need to have criteria for structure, imagine. And we need to ignore subjective comparison. And we also need to have visual reminders, mark valid structure points on the charts before entering. I do that every time. We also need to journal bias incidents. Every time we have this bias, we need to log it in so that we can notice how this bias is affecting our decision making process. We also need to review and reflect. We need to analyze missed trades to reinforce trust in the system. Like I said, I analyzed all of these trades I did not take. So I'm reinforcing my trust in this strategy and the system I'm building. And we need to practice discipline. Discipline is not born by saying, "Oh, today I feel disciplined." Discipline is born by doing the same thing over and over again, even though it's hard, even though you don't feel like it. That's what discipline is. Discipline is repeated exposure toward doing the same thing over and over. And it says here, repeated exposure helps your brain to stop overlaying impulses on retracements. It's very, very important. And with that, guys, this is where I'm at right now. Now I've been making solid progress lately. I'm keeping at backtesting every single day. I still have a long way to go. More data analysis, more data gathering, more system building, refining protocols, and creating dashboards. All of that is in the works, and trust me, it's very tedious. Very tedious. I've gotten a potential funding, so next month I'll probably get 5k funding with Alpha Capital. I'd like to say, guys, I am human. I make mistakes, but I'm learning and improving every single day. I mean, how many traders online can you hear that say I have a comparison bias? Not a lot. Guys, I'll try to keep trying to get better. Damn, that made no sense. Guys, I'll keep trying to get better. And yeah, thanks for following along with me, guys. And this is the teaser I've been hinting at since the start of the video. We have 7 trades here, and out of 7 trades, only 1 has lost. This is the original R multiple of the trades taken. So this trade made 1.94%, this one made 1.9%, this one made 0.85%, this one lost, of course, 1%, this one made 1.8%, this one made 2.02%, and this one made 1.2%. This strategy makes 1%. And if you go back again to the previous video, you'll see how just having a 1% per week system is gonna make you a millionaire in just 4 years. Guys, when we utilize depth of mitigation, we get 1 2 3 1 2 3 1 2 3 1 2 3 1 2 3 on all of them. Of course, the one that lost, I don't really care about actually seeing if you could have gotten the 1 2 3 because it lost. Guys, with that said, I'd like to say thank you and good night.